All right, welcome to The Explainer. Today, we're unpacking a truly fascinating story of ambition, crisis, and absolute power. We're going to look at how a tiny underdog bank, founded by an immigrant just to serve his marginalized community, morphed into the inescapable global financial institution we all know today. It's a wild ride, so get ready. Okay, let's dive into this. How exactly does a small underdog immigrant bank transform into a global financial titan? That is the core paradox we're exploring today. We are going to trace this unbelievable evolution from a modest local operation literally running out of the back of vegetable carts all the way to a colossal modern bureaucracy. To wrap our heads around this incredible 120-year history, we've broken it down into 5 quick chapters. First, the working class bank, then taking on Wall Street. Next up, complacency and new rivals, followed by takeovers, crises, and bailouts. And finally, we'll wrap up with the modern bureaucratic giant. Let's get to it. Starting off with Section 1, the working class bank, founding a bank for the people. So our story kicks off with a guy named Amadeo Giannini, and he had a tough start. After his father was killed in a labor dispute, young Giannini had to grow up fast, managing his family's produce business and learning firsthand the sheer value of community trust. By 1904, he was outraged that local corrupt banks were completely neglecting San Francisco's hardworking immigrants, so he just founded his own, the Bank of Italy. His inclusive model was a massive, immediate hit. They amassed $1 million in capital by 1905. But then a literal disaster struck, the devastating 1906 San Francisco earthquake. The whole city was consumed by fire. But before the flames could reach his vault, Giannini and his stepfather did something absolutely ingenious. They loaded all the bank's cash and gold onto wagons, hid the whole shebang under crates of fruits and vegetables from their old business, and basically smuggled it to safety. While all the other banks were frozen in fear, Giannini set up a makeshift desk on Washington Street and immediately started lending money to disaster victims. And here is the most amazing part. He gave out unsecured loans based purely on a handshake and personal trust. He took a catastrophe and turned it into an opportunity, making his bank the most trusted name in the region. Which brings us to Section 2, taking on Wall Street, the battle for New York. And this brilliantly illustrates the clash that was coming. Giannini, riding high on his massive success out west, had this ambitious vision for a coast-to-coast banking network. But to break into New York, he had to face down the ultimate establishment titan, J.P. Morgan Jr. It was a total clash of worlds. In one corner, you've got Giannini, working-class immigrant roots, champion of the little guy. In the other, Jack Morgan, inherited Wall Street royalty, wielding just ruthless market power. Morgan absolutely hated competition, and he viewed Giannini's East Coast expansion as a direct declaration of war. What happened next is basically a corporate thriller. Morgan launched a ruthless stock raid and smear campaign against Giannini's holding company, Transamerica. Taking advantage of all the chaos right after the 1929 stock market crash, Morgan loyalists on the board actually managed to oust Giannini from the very company he built. But Morgan severely underestimated his opponent. Giannini didn't back down. He rallied his base of everyday working-class stockholders. Because of his sterling reputation for honesty out west, the shareholders backed him overwhelmingly. In a stunning proxy fight, Giannini fired the Morgan loyalists, reclaimed his chairmanship, and successfully toppled the king of Wall Street. With Giannini back in the driver's seat, the bank's growth just absolutely exploded. Think about this. During World War II, the entire banking industry banded together to finance the American war machine. And by 1945, Bank of America had become the largest commercial bank in the world. They were boasting over 500 branches and a staggering $6 billion in assets. But here is what is so wild about that. Despite building a literal $6 billion empire, Giannini's personal estate when he died in 1949 was shockingly modest. We're talking just under $490,000. He had donated half his fortune to education and lived incredibly simply. It really proved he wasn't driven by personal greed. He genuinely lived by his ideal of building a bank for the common people. Moving on to Section 3, complacency and new rivals, the dangers of bureaucracy. So after Giannini passed, the bank initially rode that massive post-war economic boom. They even launched the revolutionary bank Americard back in 1959. But, as it grew, it kind of lost that nimble, scrappy fighting spirit of its founder. By the 1970s, the former underdog had morphed into exactly what Giannini used to fight against, a complacent, sluggish, bureaucratic giant. While Bank of America dragged its feet on new technology, their older rival Citibank took a visionary $50 million gamble on a brand new invention, the ATM, and they successfully leapfrogged right over them to become the top commercial bank in the US. Let's move to Section 4 and see how this builds. Takeovers, crises, and bailouts, a decade on the brink. That complacency from the 70s, well, it snowballed into absolute chaos in the 1980s. Previous leadership had basically used aggressive accounting to artificially pump up earnings right before they retired, handing a ticking time bomb to the incoming bank president, Sam Armacost. He walked right into a perfect storm. The bank was hit by a massive mortgage securities fraud scheme built on fake appraisals that cost them $95 million and just shattered their reputation. Add to that the third world debt crisis, the collapse of Penn Square Bank, and immense economic pressure from high interest rates. These interconnected crises severely crippled the bank's stability. And, as you might guess, a dying giant inevitably attracts predators. The Wall Street vultures absolutely started circling. First Interstate proposed to take over, but the real intense threat came from Sandy Weill, a completely ruthless corporate takeover specialist. Weill actually secured billions from Shearson Lehman with a plan to seize Bank of America, gut it with aggressive cost-cutting, and rebuild it into a superpower. Shockingly, when this news leaked, Bank of America's stock jumped. The market was literally signaling that it fully supported a hostile takeover over the bank's own leadership. Facing this total existential threat, the board orchestrated a coup. They kicked Armacost out and brought back their former CEO, A.W. Clausen. And to save the bank, Clausen pulled out what's known as a poison pill. It's a defensive finance strategy where a company issues a ton of new shares to existing shareholders, instantly diluting a potential acquirer's ownership. This made a hostile takeover mathematically prohibitively expensive. It worked. Clausen fended off Sandy Weill, preserved the bank's independence, and managed to steer it back to profitability by the late 80s. Which brings us to our final chapter, Section 5, the modern bureaucratic giant, too big to fail. Now, what's really interesting is what happens when we fast forward through the euphoric merger mania of the 1990s and early 2000s. Bank of America expanded so fast and so aggressively that when the catastrophic 2008 financial crash hit, they found themselves heavily burdened by toxic mortgage assets, largely from acquisitions like Countrywide Financial. To keep the bank from collapsing entirely and taking the rest of the financial sector down with it, it required a staggering $45 billion government bailout from taxpayers. The fallout from 2008 left the bank completely battered. They were facing a massive crisis of confidence, and their new CEO, Brian Moynihan, knew that in banking, confidence is literally everything. To stop the bleeding, he managed to secure a massive $5 billion investment from Warren Buffett in 2011. Having a legendary investor like Buffett publicly back the bank injected a desperate, much-needed wave of confidence back into the market, and that finally helped stabilize their plummeting stock. So that brings us right up to the present day. And it's really a dual reality for the modern Bank of America. On paper, financially, they show undeniable strength. They are a dominant force in digital transformation, they've got robust earnings and high dividends. But culturally, the customer reality is a bit bleak. The bank is heavily burdened by its own massive bureaucracy. They face an ongoing stream of consumer complaints, things like unauthorized accounts, withheld rewards, and poor customer service, which has actually resulted in massive fines for regulatory non-compliance. So the crucial point is this. As our sources point out, it's all about the brand of trust. We've watched this institution evolve from Amadeo Giannini moving gold in vegetable carts to serve disaster victims into an ultra-complex megabank that occasionally requires billions in taxpayer bailouts. And it leaves us with a provocative thought to end on. Can a modern bureaucratic giant with tens of millions of customers ever truly reclaim the personal trust of Giannini's 1906 handshake loans? Keep that in mind the next time you look at your bank statement. Thanks for hanging out with me for this explainer, and I'll catch you next time.